Forex versus stocks. What's the difference? Market size. The Forex market is huge, with a daily volume of $6.6 trillion, making it the largest financial market in the world, dwarfing the stock market by a factor of 10, which stands at a relatively insignificant $200 billion mark. It is also much easier to enter than many other financial markets because you don't need to invest or trade large amounts of money to get started. But more on that later. Liquidity. Liquidity refers to how easy it is to buy and sell an asset. If an asset has high liquidity, then you can easily buy or sell the asset whenever you want at a fair price. Forex and stocks have different levels of liquidity. Because the Forex market is so massive, you will always witness high trading activity on a daily basis. This means millions of people are buying and selling currency pairs every second. So, it is extremely easy to find buyers for your assets whenever you want to exit. Liquidity in stock markets depends on stock exchange rules, which can also be subject to change upon government intervention and/or natural disasters or events like terrorist activities or political unrest in countries where companies are listed for trading. Moreover, some stocks are more popular and desirable than others, so the liquidity will vary according to the stocks that you are dealing with. If you are trading popular stocks, you will always open and close quicker than otherwise. Trading schedule. Forex markets run 24/5 and are only closed during the weekends. Stock markets, on the other hand, have definite closing times. You can only open or close a position during these specific time frames. In some cases, stock markets can even be closed for days due to natural disasters or national emergencies like war, which reduces their flexibility. Commissions. Forex has no central clearinghouse, which means that trades can be conducted with a broker of the trader's choice. So, you are in complete control of the commissions you give out on your trades. When you trade on the stock market, on the other hand, you must use a member of the stock exchange, and this dictates who you can deal with and how long it will take to complete your transaction. Because of this centralized system, brokers usually charge a standard commission that's quite high and can eat into your profit margins. Transparency. The Forex market is more transparent as it is run by a global community. The same amount of information on currencies is available to every trader regardless of where they are trading from. The stock market is run by companies that can choose to withhold information, as we have seen historically. There is less transparency, which is why traders are required to do more in-depth research before starting. Profit margins. The majority of people can participate in the Forex market because they are not required to buy large blocks of assets to get started. Smaller investments are sufficient to see real results, making it possible for people with small budgets to participate in the market and potentially earn big returns on their investments. This is also why the Forex market is perfect for traders to learn as they grow. As you might have guessed, the stock market isn't that flexible. You need to invest large sums of money to see measurable profits, so they aren't ideal for beginners or small-time investors.